This is the Daily Market Rundown live from the Tradelo trading floor. It's September the 12th. Some highlights from today's show. The US data now reveals more stagflation. US rates are very dovish and US inflation is now accelerating. Happy Friday. Welcome everybody to the final daily market rundown of this week. Don't worry, we will of course be back again next week. But let's get stuck straight into it because I think there is a general theme that is now starting to develop with the US data. It is this theme of just continued weakness, softness, not necessarily falling off a cliff, but definitely softness. And it's not just this week, it's not just this month, it's been for the last couple of months, 3-4 months now. Now, does that ultimately mean the Fed is suddenly gonna accelerate and cut? Well, possibly they are definitely gonna cut next week, but it is very much an open question as to what they do beyond that point. Okay, and I think the key theme from today's stream is gonna be all about this idea that, the Fed ultimately needs to cut from a labor market stance, from an insurance stance. But if we have a look at the inflation data, they have very much got a scenario now where they are going to be cutting into inflation that is accelerating. Okay, that's problematic for a number of reasons because they are stimulating a market that doesn't need stimulating. Okay, a difficult problem to handle, but what it does mean is if they are going to cut and they're going to be aggressive and they're going to be dovish, they are going to create a reacceleration in inflation, a reacceleration in demand, and all of that will point to some sort of volatility picking up at some point. Okay, not this week, not today, but definitely over the coming months. Okay, now let's get stuck straight into it. Let's talk a little bit about what's happened overnight, some of the key news. I think going into today's session, it's been a relatively calm week all week. That's been the theme. It's very much been about selling the VIX, buying the equities. That has been the trade all week, buying the dip, just being long, and any kind of volatility that we've seen, even a little bit of volatility, has been faded very, very quickly. Okay, got to look at the S&P, look at the Nasdaq, look at the Russell. All of them this week, to some extent, had a little bit of a sell-off. It was very, very small, very, very contained. Once that initial selling was done, the market then accelerated, and we made new highs pretty much every single day this week. Okay, the point is, these markets are bullish. They are short-term bullish. I think you have to stay bullish, particularly now whilst we're in record territory. We do have a day 2 trend set up in the S&P 500. What that points to is an extension of yesterday's highs at some point today. But ultimately, this is likely to be the landscape we will be in until we get towards Wednesday, Thursday, Friday next week. Okay, it's very much a case of coming in Monday, Tuesday next week. Expect the same. Okay, which is the market will hold on to these gains until something changes. Okay, we'll discuss, of course, this all of next week. But there you have got a snapshot. It's a relatively positive week across the board, not just US markets, Asian markets, European markets. Everyone's happy. That's the point. Okay. Now, getting on to the daily market squawk from Tradelo.com, there's a few things to pay attention to. Trump administration has now pushed for a very urgent ruling on Lisa Cook, effectively banning her, upholding the firing so that she cannot vote at next week's meeting. Now, this does matter. This is some headline risk that I think will present a tradable opportunity for us. The way to think about this is there's a unique law in the US where if the Lisa Cook situation poses some form of material risk, ultimately the court could uphold the hearing and then allow the case to continue. In other words, they could actually uphold Trump's initial firing of Cook because they find that there is sufficient amount of detail that warrants the firing. Okay, now this can go two ways. I don't think the market is expecting this to be upheld. I think it's a very, very small chance that they do actually uphold the firing, and therein is the opportunity. Okay, should they uphold it, keep in mind it means that they have got a limited amount of information, but they're willing to make a material verdict on that limited information. Okay, so it will point to a situation where the probability of it being fired is a lot greater than what it currently is today. Okay, and again, it will just open the door to this idea of independence of the Fed and blah, blah, blah. Okay, the play there is very simple. Long gold, short dollar, long the front end of the bond curve, and then of course short the equities. Okay, so keep an eye on that. It's definitely a headline risk. I suspect we'll get something about this most likely on Monday. Okay, then in terms of some of the other news, I think the US inflation data yesterday did not disappoint. Of course, the equities flew up the page, but I think there is definitely a few things to pay attention to within the data. Of course, the shelter component was accelerating again, but there's something that was perhaps missed yesterday, and it's this idea of it's not just this one data point, but perhaps what's happened over the course of the last 4 data points. And I'll show you that chart in a minute, but I think Lisa Wong, is it Lisa Wong? I think it is Lisa Wong, the economist at Bloomberg. She's come out and she said that effectively there is a scenario where she's warning that, if the Fed is going to start cutting now and they're going to follow the path of the rates curve, ultimately that is going to re-accelerate because the economy is not as weak as expected. Okay, so what she's leaning on is this idea of they providing perhaps too much stimulus to economy that doesn't necessarily need it. Okay, and her sort of thinking is that you wouldn't typically see airfare and hotel inflation in a scenario where the economy is drastically slowing. Okay, so there's quite a little bit of logic there. She is quite smart. She is quite astute. So something to be said there, which is perhaps we may be entertaining a hawkish cut next week from the Fed. We will, of course, talk about that and the implications. I think it'll be a wonderful trade for us. And I will explain how that works when we get to Tuesday next week during the FOMC rundown. Okay. Then in terms of the chart, I think this is what I wanted to point out. It is the month-over-month change from both the headline number as well as the core. Okay, core in red, headline number in blue. Now, it doesn't take a super smart analyst to go and tell you that over the course of the last 5 sort of 4 prints since we had the tariff situation, okay, what we can see is that this is going up. Okay, now keep in mind that everyone's telling us there is no implications of tariff inflation. We're not seeing anything. When I look at this chart, I just see month over month inflation is going up, not down. Okay, so this is the concern that ultimately I think we need to be aware of. I will also show you in a minute a chart where I think the markets are concerned about this. You're not seeing it so much in the equities, and that's simply because I think equity traders typically are a little bit more over-optimistic. Okay, so we'll get to a chart in a moment. I think it's very, very relevant, but just keep in mind inflation is accelerating and the Fed is not unaware of this. Okay, this ultimately is why I think the Fed comes out with a hawkish cut. In other words, they cut, but they push back on this idea that it's going to be a cut at every other meeting. Okay, right now, as per the rates curve, they're pricing in 4.5 cuts over the next 6 meetings. Okay, in other words, we're one bad data point away from them almost pricing in 1 cut at every one of the next 6 meetings. Okay, that is quite dovish. And if you've been with a daily market rundown, you will know that this is the 3rd time within this rate cycle where the market has priced in very aggressive rate cuts, 6-7 rate cuts in the near term, and every single time it's been proven wrong, those trades have had to unwind. Okay, the point is the market is now well ahead of the Fed. The market is now well ahead of the inflation narrative, perhaps because it's focusing on the employment narrative. Okay. And so it's important to understand, because let's say we got next month the non-farms payrolls print around 95,000. All right, that will really kind of change the dynamic in the rates market. It will call into question, how aggressive the rates market is currently pricing things. With that in mind, let's have a look at the initial jobless, and then we'll get over to that rates chart, because I think it is one to see. This was one that was a bit of a head scratcher. It was the initial jobless. We paid attention to it yesterday. It was the highest initial jobless print since 2021. The net weekly change was quite significant as well. And the market did respond to this. Okay, we saw, of course, yields very, very quickly sell off. But ultimately, it was put down to this idea of a strike in Texas. And so the general thinking is that that should unwind next week. Now, therein is a key trade for next week. Should this not unwind, should we see another pick up in the initial jobless claims next week, that is perhaps going to start to point to something more sinister than just what's going on in Texas. Now, one thing that keeps me always almost baffled in a sense is it was very quickly put out there that this was due to Texas, and everyone was aware of it, and yet no one put it in their forecast. And so that for me is always a head scratcher. Everyone gets, these big banks get the opportunity to write down what they think the initial jobless claims is, and we have a median number, and yet no one forecast this. Okay, so again, what does that mean? I don't know, but take everything with a pinch of salt and just pay attention to next week's initial jobless. It will have an outsized sort of impact on the markets next week, given ultimately it's expected to come back down. Okay, that is what's expected. If it's a Texas situation and it's sort of very much seasonal in a sense, it should come back down and revert next week. If it doesn't, okay, different ball game. That's a whole different scenario, which we'll of course get over to next week. Now, there is the rates chart. I think it's an interesting one to look at. And what prompted me to think about this is I've been trying to buy the euro and the 2-year bonds all damn week, and it's been one of the most frustrating rides where I've gone on side very briefly and spent most of my time off sides. And that is, of course, post the very bad non-farms that we spoke about last week. It's post, of course, a number of sort of bad data points that we received over the last couple of days and weeks. So I've kind of been scratching my head as to why on earth is the dollar now not pairing. We've spoken about this consolidation that's been in the dollar for the last 5 weeks, and yet dollar cannot go down. And so that's always an interesting observation that I make for myself, is when the macro suggests we should be doing one thing, but we're not doing that. I always want to be switched on and alert to that, because it suggests a number of things. One, it suggests perhaps the market was expecting it. In other words, it's already in the price. Another is ultimately that the market is perhaps full. Okay, so the concept of a full market means everyone that wants to be short dollar is short dollar, and we would need something significant to ultimately get that initiative to come back into the market. Okay, so there's a number of reasons why these things happen, but we cannot discount that they are happening because it means something. Okay, now why I'm mentioning this is because if we go and have a look at the rates charts, as you can see in front of you, that is the non-farm payrolls day there. Okay, you can see rates moved quite aggressively around 12 basis points. This is, of course, when I say rates, this is looking out towards June next year. Okay, why have I picked June? Well, because this is kind of the next 6 meetings where we're expecting 4.5 cuts. Okay, so what we can see is all of this sort of acceleration in the rates started with the very bad non-farm print we had at the start of August. We, of course, then got a little bit more volatility on Jackson Hole when Powell opened the door to a continuation of rate cuts. And we can see that we're just drifting higher on all this weak data. And then, of course, we had the non-farm payrolls. Okay, so since effectively, call it the 1st of August, over the last 6 weeks, we've priced in, call it a good 50 basis points. In other words, 2 more rate cuts have been priced in since that bad non-farms that we got in August. Okay. Now, what this ultimately means, or how I'm starting to interpret this, is that given the current data and given, of course, the dual mandate of the Fed, right now the market is very well priced given all the data we know today. Okay, there is definitely a concern. There's definitely sort of this idea of a re-acceleration of data over the course of the next coming months as, of course, a lot of the fiscal stimulus starts to hit the market. But the point is the market right now, it is priced I don't want to say to perfection. Of course, we can price in more rate cuts. You can see this blue line here is ultimately the neutral rate. So there is still a good, almost 35, 40 basis points the market can price before it's effectively putting the Fed at neutral. But I suspect if you look further along the curve, you'll see that the market's already pricing the Fed to get to neutral. In other words, the rate cut cycle is fully priced by the markets right now, and the market just needs the data to keep coming in the way that it's coming to justify that rate cut cycle. Okay, so what does this all mean? Well, it means that the market is very, very dovish. It means equities are at record highs, and to sustain this record highs, you're going to need some new information. Okay, it might be some better earnings coming out. It might be reacceleration in growth metrics. It might be non-farm payroll starts to turn around. The point is that right now, the equity markets, the bond markets, they are fully pricing in a rate cut cycle all the way back to neutral. Okay, and that's what you need to know, because a lot can change now as we get into the Fed meeting next week. Of course, they can revise up where they think their neutral rate is. They can push back on this idea that they're going to cut very aggressively given inflation is starting to accelerate. And there are a number of trades that are going to come unstuck. Okay, I mentioned the dollar. Okay, that's that consolidation trade, that market that is wanting to do something. It's got record short dollar positions via CFTC data. The point is, if we get a hawkish cut next week, or we start to see these rates push back a little bit, Don't be surprised to see some very aggressive moves in the equities, some very aggressive moves in the dollar. Okay, there's definitely some tradable opportunities next week, but just be aware the rates market right now is fully pricing in a rate cut cycle from the Fed. Okay. Talking of central banks, the ECB did not disappoint yesterday. They were pretty much boring as usual. But I suppose that's what happens when central banks, have policy either at neutral or when we get to the end of cycles. Okay, if you've ever taken the Tradelo central bank course, you will know that the time to be most switched on with central banks is, at the beginning of a cycle, whether it's a cutting or hiking cycle, because that's when you get the most repricing. Okay, and that's when you get the most volatility as a result. The ECB, of course, did their last cut already earlier this year. They are pretty much on hold. They've very well telegraphed they're on hold. There was one interesting line yesterday that created a little bit of noise, but doesn't really mean anything. And it was this line of Lagarde declaring the disinflation process is over. Okay, and I think the market took it as this idea that perhaps that one last rate cut that is priced into sort of the middle of next year, perhaps it's not necessarily gonna happen, but the point is that that rate cut wasn't expected anytime soon. Okay, it was priced quite far out, which is the middle of next year, and so as a general rule of thumb, if you take the central bank course, you'll learn this, but as a general rule of thumb, as we get to the end of a rate cut cycle, the impact of central bank meetings is far less, or it's far more muted on the markets. Okay, it did not disappoint. The ECB is now on hold until further notice. Does that mean the ECB doesn't matter? No, there could be, of course, some movement. We do know the ECB downgraded their growth forecasts for next year. They are sitting with an expectation of inflation to come in around 1.7% next year. It's not quite 2%, so should we see a little bit of growth deterioration next year, and we start to see them revise down those inflation expectations for next year, the ECB could very much be cutting again relatively soon as we enter next year. Okay. The point is they don't matter now. They could matter. We keep an eye on the data, but keep an eye with sort of half an eye. What that does mean, of course, is trading markets like the Schatz and the Bund do become perhaps boring and dead. Doesn't mean you can't make trades, but of course the opportunity scope will be limited. Okay, and there's a great lesson there for particularly those of you that are new or young traders. Trade where the opportunity scope is. Okay, trade a market that provides a lot of opportunities, and in the same way that the S&P will be muted in a low VIX environment and have a lot of opportunities in a high VIX environment, you need to also apply that same logic to other markets. Okay. And then in terms of the euro, there is the chart. As you can see, this was the non-farms day. We broke out of that range, looked very good in terms of a close, came in on the Monday and shanked it straight back into the range. Okay, the point is at a technical level, this market is telling us it does not want to go higher. It's also telling us that it's suffering from a bit of a lack of initiative to the upside. Like I said, I suspect the dollar short play is very full. No one wants to take this market up yet. If we were to get a hawkish cut next week, I do suspect that euro is going to be a fantastic trade to the downside, and perhaps we do retest somewhere in around that 114. I'm not sure we'll get much lower than that. I think we get anywhere near 114, and I will be a very happy buyer. But it does look like this market has got a few stale positions, and so we will be paying very close attention to that 116.5 level over the course of the next week or two, because that is a level we want to attack as we, of course, take out some of those perhaps a little bit overzealous bullish euro-dollar positions. Okay, and then in terms of data today, we've got University of Michigan Consumer Sentiment. Always an interesting one to watch. Of course, we do get the inflation expectations. It's not the only survey for inflation expectations we get. We get the New Yorker one as well. This has mattered in the past. I suspect it matters a little bit less today. What we do pay attention to is ultimately the actual sentiment number. If that number comes in very, very weak, yes, consumers are typically a good leading indicator of economic sort of situation. So we do pay attention to it. But what a weak number would be today is somewhere around that 50 level. Okay, somewhere around 50. Yeah, that's going to create a little bit of concern, given it's kind of come out of nowhere. We did, of course, if you go back to the start of this year, we saw that consumer sentiment really sour as a result of the tariffs and the uncertainty. It did then bounce once we got the 90 days. So again, if we were to see something like a 50, we have to ask ourselves why. What's created that sudden drop-off in sentiment? Is it people losing their jobs? Is it people irritated by higher inflation? Is it there's a number of things that can create the survey negative numbers. the point being is that there would be a lot of fingers pointed towards, you know, some form of maybe economic deterioration that's taking place. Okay, so keep an eye on it. Anything below 50 or in and around that 50 number perhaps could create some trade flow. But like I said, aside all things being equal, expect more of the same today as we've had all week, which is you'll see a little bit of downside volatility in equities, buy the damn thing, take it back up to record highs, lock in the profit, and go home and come back on Monday. Okay, that is the key takeaway from today. And that, of course, then is a wrap for today's daily market rundown. If there are questions, as always, do post them in the Discord channel. Do comment, like, subscribe, thank me, and all those wonderful things as well, because it's nice. And don't forget to share the channel. It helps. The more we can share this channel, grow this channel, the more inclined we are to keep this channel going. All right. Any questions, do post them in Discord. Otherwise, good luck out there. Manage the risk. Go make some money.